Warren Buffett, often referred to as the Oracle of Omaha, is one of the most successful and respected investors of all time. His investment strategies and philosophies have been studied and emulated by countless individuals and professionals in the financial world. One of the key aspects of Buffett's approach is his ability to navigate through market volatility with a calm and steady demeanor. In this video, we explore Warren Buffett's timeless advice for weathering market volatility and maintaining a long-term perspective. Embrace volatility as opportunity. Warren Buffett is known for his famous saying, "Be fearful when others are greedy, and be greedy when others are fearful." This sentiment encapsulates his view on market volatility. Instead of fearing market fluctuations, Buffett encourages investors to see them as opportunities to acquire valuable assets at discounted prices. He believes that a long-term investor should not be discouraged by short-term market turmoil, but rather should be prepared to capitalize on it. By approaching volatility with this mindset, an investor can potentially profit from market downturns by buying quality stocks at lower prices. Focus on intrinsic value. Buffett's investment philosophy centers around the concept of intrinsic value, the true worth of an asset based on its underlying fundamentals. He advises investors to focus on understanding the businesses they invest in, rather than being swayed by short-term market sentiment. By thoroughly analyzing a company's financials, competitive advantages, and growth prospects, investors can make informed decisions that are less influenced by market volatility. Buffett's approach reminds us that the value of a company doesn't change dramatically just because the market does. 3. Diversification and concentration. Buffett's perspective on portfolio diversification is nuanced. While he acknowledges the importance of spreading risk, he also cautions against excessive diversification. He famously said, "Diversification is protection against ignorance. It makes little sense if you know what you are doing." Instead of holding a vast array of stocks, Buffett suggests focusing on a few businesses that an investor truly understands and believes in. This approach combines diversification to manage risk with concentration to capitalize on meaningful opportunities. The long-term mindset. One of the cornerstones of Warren Buffett's success is his unwavering commitment to the long term. He often emphasizes that he buys stocks to hold them forever. This patient approach to investing allows him to ride out short-term market fluctuations and benefit from the compounding power of time. Buffett's advice to only buy something that you'd be perfectly happy to hold if the market shut down for 10 years reinforces the importance of investing with a long-term perspective. Cash is a strategic asset. In times of market volatility, having a cash reserve can be a strategic advantage. Buffett recommends maintaining a comfortable cash position to take advantage of opportunities that may arise during market downturns. This approach not only provides liquidity for investments but also offers psychological comfort during turbulent times. Having cash on hand allows investors to remain patient and make rational decisions instead of being forced to sell assets in a panic. Avoid emotional decision-making. One of the greatest challenges investors face during market volatility is managing their emotions. Buffett is a staunch advocate of making rational, disciplined decisions rather than succumbing to fear or greed. He famously said, "The most important quality for an investor is temperament, not intellect." Buffett's advice is to stay focused on the fundamentals and long-term goals, rather than reacting impulsively to short-term market movements. Buy when others are selling. Contrary to the common tendency of selling during market downturns, Buffett recommends considering buying opportunities when others are selling. He believes that successful investing requires a contrarian mindset, going against the crowd when it makes sense. When panic selling occurs, prices of quality assets may drop below their intrinsic value, presenting astute investors with attractive entry points. Avoid market timing. Buffett is a vocal critic of market timing, the practice of trying to predict the highs and lows of the market to make buying and selling decisions. He believes that attempting to time the market is a futile exercise and that consistently successful market timing is nearly impossible. Instead, he advises investors to focus on the long term and make investments based on a company's underlying value rather than short-term market movements. Be prepared for volatile times. Buffett's advice for weathering market volatility extends beyond just reacting to market downturns. He believes that investors should always be mentally prepared for market fluctuations. A key part of this preparation is knowing the businesses you invest in and understanding how their value may be affected by various economic scenarios. This knowledge equips investors to stay the course during volatile times and potentially make strategic moves when opportunities arise. Learn from mistakes. Even a seasoned investor like Warren Buffett has made mistakes. However, his approach to learning from these mistakes is invaluable. He advises investors to assess their failures objectively, understand what went wrong, and use these experiences to improve their investment strategies. Buffett's transparency about his errors serves as a lesson in humility and continuous improvement for investors at all levels. Conclusion: Warren Buffett's advice for weathering market volatility is a testament to his wisdom and success as an investor. His emphasis on a long-term perspective, understanding intrinsic value, staying rational, and being prepared for market fluctuations provides a guiding light for investors navigating the often unpredictable world of finance. By embracing these principles, investors can potentially not only survive but thrive amidst market volatility, following in the footsteps of one of the greatest investment minds of our time.